Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. Special market call, that is G Swizz. You see him talking, his lips are moving. But of course, the great Carter Braxton Worth, Dan, is on a plane to San Francisco. I don't know if he's landed yet, but probably close. It is Tuesday. It's the 21st of October, still the aftermath of a disastrous giant game, but I digress. Carter, how are you?
I'm good. How are you?
You are more than good because, you know, your calls have been, as they typically are, unbelievable. And the latest one was to take some profits in gold. And I want to start there because that's not bearing the lead. This is, as many of these days to the upside that we've seen, the sell-off today is notable just in terms of the dollar amount. I mean, this is over a 5% move, basically a $230 move to the downside in gold. It was you that said it was time to sort of pull the ripcord. What I have been saying is I don't believe the gold trade is over. I said, but, you know, vis-a-vis or due to some of these just overbought conditions, which historically we've never seen, you know, this is sort of late innings in terms of this portion of the move. So let's look at the charts that you brought and sort of walk us through that.
Sure. So the one thing to note before we get in the charts is that gold is also, as of last Friday, pulled off something that's exceedingly rare, right? It advanced for 9 weeks in a row. There's only 5 other, this being the 5th instances, going back to the 1970s, we, you know, sort of went off the gold standard where that's happened. And if you look forward 1 month, 3 months, 6 months, 12, 24, gold is lower every time except one. Now, we shall see, but you know, excess, even if it's just an intermediate moment of excess that then gets a pullback, as of now, that's all that this can be characterized as, or it ends up being a major and important top, which is something that has to be considered for silver here. The messaging, of course, is you do a little too much, and you know, so here is gold. Now, the red line is not arbitrary. It looks arbitrary, but it's not. That is the prior peak in gold, the epic run, the 1975, 1979, 80 run when we had treasuries trading at 16, 17%. We had true inflation. We were coming off of the sort of oil embargo, gasoline through the roof, people waiting in lines and all that stuff. Now, that's gold itself. The next chart is gold adjusted for inflation with the same red line. And the point being that it was only in the last 12 months that we exceeded gold prior real high, right? These are gold in nominal terms versus adjusted for inflation. And so that's an important thing, both to in and of itself, but also as it relates to silver. So let's look at silver and then we can put it all together. Silver just this last week got above the high of 2011, which itself, as you see there, was the high of the Hunt brothers. So this is an epic level, and silver is now down. But here's the real kicker, the final chart. Silver adjusted for inflation, of course. When silver would have to go to, I think it's probably 150, 175 an ounce. In fact, the last chart, silver would have to move up about, you know, 200% from here. So that just shows how incredibly excessive the silver move was. And we know that not only was it the condition of precious metals at the time, the, again, 10-year treasuries yielding 16% real inflation, but there was also something that was idiosyncratic, right? You had the Hunt brothers attempting to corner the market. And you know, quite remarkable. Do you know, my recollection of that, I haven't read a bit, reading about it, of course, you and I were in grade school at the time or just getting ready for high school, but the Hunt brothers, they changed the margin requirement.
That's right.
And that happens. I've had that in futures accounts where, you know, something's getting hot and they up the ante, and I have to either cut back the position or put money in to keep the position, even though it's working. It's not like adding to a loser. It's just that they're requiring more capital. But it was my understanding that they actually targeted them. It was a way to break.
100%.
And the only other time that had happened, it's illegal, interestingly, is that the marginal tax rate in this country got as high as about 94%. over a certain level. They were after Rockefeller, right? They put it at a certain level where no one made that kind of money except one person. And then someone said, "What are we doing? This is not how the U.S. operates." And so I think they did do it because this was crazy and they wanted them to stop. But either way, here we are. This is an epic moment for precious metals. This is a big reversal today and yesterday for both gold and silver. Now the question is, and there is no answer, I don't know, is this just a pullback in the ongoing move higher? Or, of course, is this somehow an important and enduring top?
Yeah, and just to sort of amplify, I think it was late 1970s, it might have been 79 or something, and the estimates were the Hunt brothers had about 100 million ounces of silver. So they were basically, I think they had about 1/3, excuse me, of the global supply of silver that wasn't held by governments. As a matter of fact, I think that Tiffany's, took out an ad condemning their actions. And you're right. I mean, the market participants or the market structure basically changed the rules on two brothers that basically beat the game. So, and you see how quickly the price went up, but subsequently how quickly the price went down. So that was a fascinating times, but before my career started, clearly.
And also, I guess what's so funny is, it's like in the movie, so no one remembers they're not even remembered for being the oil guys. They're remembered for all time for having tried that very gutsy, and
they gave it a shot and they won. They beat the game, and then the game changed rules anyway. So a lot of people obviously asking about then subsequently the mining stocks and what we're going to see today, and this should come as no surprise. As far as gold is down today in percentage terms, which is about 5%, the mining stocks are probably down double that, and the GDX obviously is having one of those days to the downside, and that's what happens. I mean, the mining stocks were late to participate, but they're also going to be early to sort of pull the ripcord because people have been smoked too many times. And one of the things that I've been saying, and I think you may agree with this, I don't think the entirety of this move is over, but I think given the extensions and the overbought conditions that we found ourselves in, and the multiple standard deviations away gold has been from the either 150-day or 200-day moving average, this move makes sense. But I also want to say, before I give it back to you, I thought this move would take place if and when the broader market, the equity market, sold off. So I thought gold would sell off in a risk-off situation, but that's not what we're seeing here. The S&P is up again today, pressing up against new highs. The Dow's up 1%-ish, but yet gold is doing the move. So anyway, sometimes you can be right, but in this case, the wrong reasons.
Yeah, it's the down 15%, GDX, the ETF that measures gold mining stocks, gold and silver, but largely gold. There is one for silver, the dedicated SIL. But the point being that you get it both ways, good and bad, right? There's operating leverage in a company that can give you a double. Gold miners have doubled the performance of gold bullion over the past 12 months, essentially. And that here is the opposite. Gold is down 5-6, and this thing's down 15. It's just the nature of the beast. Generally speaking, there are a few large cap stocks, and most of them have gotten larger, but Agnico Eagle and Newmont and a few others. But gold miners as a group, and certainly silver, have been, generally speaking, small and mid cap names. So this is these are big runs, and you trim, you reduce, you take some measures, and that's kind of all one can do.
Yeah, and I think I don't know if we're going to target necessarily in this case the 150-day moving average, which is about 34.5. This will go up each day, by the way, just on time decay type of thing. But again, what we've pointed out is the miners are typically mirror the 150-day or the 200, and then obviously since September there's been this decoupling. So in this case, you're going to have some reversion to the mean. So I don't think it's out of the realm of possibility to see this thing trade down, the GDX in this case, mid 60s or so, and then we'll have another conversation, sort of that if and when thing.
Yeah, always hard to know how far. Again, a dip, a sell-off, a correction, a decline, a drop, a drawdown, a give back. The words are interchangeable because, as we know, there's no definition for a correction. You can look the world over. The 10% thing is not written anywhere. It's written by people in the modern era. You cannot find it throughout history. So when you've advanced importantly and firmly and brilliantly, at some point you give back. And this is only 2 days old. One would have to assume it's lower. As to how far down, anybody's guess.
Do you think we have some questions? One of them's from Carter Evans, your namesake, but different surname. What's going on Bitcoin versus gold? There seems to be sort of this inverse thing going on. Historically, I don't want to say they've traded in tandem, but sort of. And then over the last, I don't know, month or so, I think the inverse has been true. So on a day where gold's getting smacked, you have Bitcoin up a couple percent. Thoughts on that?
Yeah, so originally, and there's not a lot of history to Bitcoin, as we know, it was called digital gold. That has been abandoned. You can just do an AI search for the use of that phrase in media, in written reports, because it turns out Bitcoin is much more correlated with risk assets like the stock market and certainly high-flying tech and so forth than it is with silver or gold. So in and of itself, let's just address that. I mean, Bitcoin is sold off to a level of support, and my hunch is it stabilizes here. If I had endured this sell-off of the past 8-10 sessions, I'm not sure I would be dumping it here.
Yeah, maybe we traded down and held or bounced off of, again, in this case, the 150-day. So let's move on to the S&P because, I was one of the people, and it doesn't matter what other people think. It really, in my world, it only matters when I'm wrong. And the S&P just, I thought October, and here we are on the 21st. So we have some time left. But, I thought we were seeing glimpses of that potential for a pretty significant move to the downside. Technically, in terms of some of the patterns that we saw a week and a half or so ago, obviously we saw some pretty dramatic downside days along the way, but some of these engulfing patterns that we saw and some of the vol that we saw, I mean, we had a VIX that traded almost, I think, to 28 at one point. Obviously it's lower now, but I thought all the things were sort of lining up for your typical November. Now, with that said, as I mentioned, there's time left in the month, but you pick your head up today and look at an S&P that's basically at 67.48. I think the all-time high is 67.65 or thereabouts. So it's, we're right there, Carter. So I don't know if there's anything to sort of talk about here other than, it's a continuation of this theme.
Yeah, I mean, there's so many ways to look at it, right? Obviously, it's the steep nature of the move off the April 7th tariff low and up some 40% from that point. But one can also take a look at the whole circumstance this way. How is the S&P doing from the point before the tariff occurred? Meaning that would be February, that was February 15th, 18th, 19th, before we had the 21% sell-off. The S&P is up 9% from the pre-tariff sell-off high, which means the S&P is annualizing at a rate of about 15%, not much more than a normal year going back for about 100 years. So the recovery is steep. And look, to my eye, it's due for something very meaningful in terms of a check back of sorts. But here it sits. It keeps fighting. It is a remarkable thing, Guy.
Yeah. Well, yes, it is. And, again, what was remarkable to me, and I know you can speak to this, what we saw last week or the week before in terms of the moves to the downside, they were not outside the norms. There was nothing unique about them. There was nothing particularly scary about them, in my opinion. Yet you had a volatility index, as I mentioned, you had this move on, I think it was October 16th, north of 25. At one point, again, it was 28. And, it didn't really make a lot of sense to me, given the magnitude of the equity move. And what I thought, and I was trying to connect the dots here, maybe the leverage in the system is finally catching up, and maybe we're on the precipice of something. But just as quickly as we got 25 to 28, that's how quickly we were right back down to 17.5, 18. I mean, I'm not looking to pin you down here because we're not trading the VIX, but did that strike you as unusual, or is that just sort of an anomaly?
Yeah, I mean, the VIX by definition is spiky, right? It can never trend. It has to always sort of mean revert back to a level, call it 15 to 25, with these spikes that are epic, and then moments where it stays very depressed. But remember, I think there's this to say that It's a third derivative. So you remember you
Hmm.
might be putting together a report in school, and there's primary source, secondary, tertiary. So we know that the primary source are equities, and options are derived from equities, and the VIX is derived from options. You're getting, and some people say the VIX predicts. The VIX doesn't predict anything, right? It
Yeah.
is simply a numerical thing. It has a concomitant move with the move in the underlying principal asset, which is stocks. And so hard to use it as a predictive tool,
No,
but
that's
it
fair.
certainly it is a tool that it does spike and mean revert. And this is one heck of a spike and one heck of a reversion over the past
Yeah.
2 recessions.
Look, no question. I mean, I guess the point maybe I was not making is just the nature of that move, given the magnitude or the lack of a magnitude of the downside move in the equity market. Like it just seemed excessive to me. And you're right, it's not predictive, but I guess what I was trying to glean from it is, okay, is there something out there that this spike in the volatility index is sort of, portending or a harbinger of something? And look, obviously today it doesn't appear to be the case, but in my mind, I'm saying, okay, I think we've seen glimpses of what the volatility index can do on what was, again, a pretty benign day. So, we'll see. But as you look at the market today, nobody necessarily wants to look at that because it seems to be business as usual. Anyway, quickly moving on to a couple things. We have Netflix today after the bell. Last earnings report, the stock was making a new all-time high at the time. Pretty high bar. We had Tom Rogers came on Fast Money that afternoon, and for the first time in a while, Tom, who had been a steadfast bull in the company and in the stock, changed gears a little bit and said, he was seeing things that, suggested a bit of a pause. And, that's what we've seen since the middle of June-ish or end of June. We saw a stock that stalled off and then has been sideways since. Is there anything in the Netflix setup technically in the earnings today that sticks out to you?
No, it is. It's a pair of twos to my eye. It's something that is just sort of quiescent, stalled, if one wants to take a little bit less sanguine a view. But it's 250-50 from my seat to make a big bet. Now, we know that the implied move is huge. It usually is for Netflix. And this time, again, I think it's between 6 and 8%, that kind of thing. Yeah, this is one where I would just not make the bet, which doesn't help you if you're in. If you're in, maybe sell some calls or buy a little protection. But I wouldn't be just betting on a speculative basis for a directional move because it looks too much of a jump ball to me here.
We have a lot of questions about Google, and Google was a name that obviously was not performing for the longest period of time. I mean, it was just in April that this stock, I think, was trading about $140 or so. That's not that long ago. And then the stock, it didn't double, but probably went up 85% or so since those April lows. But we traded up to, I think we traded up to sort of 255-ish or so in mid-September. We traded off. We just got back there. And now we're having this pretty sharp decline today. I don't think that period of time is enough to sort of make this declarative statement of a double top, but there's obviously something going on, and people are asking you if you've seen anything technically in terms of Google.
Well, it's just to my eye, it's sideways after a very impressive move. We know it's gone from 140, the April 7th low. Almost all stocks have that same intraday low, tariff related. And then what a move. What a gap up, what a breakout, what a news related positive affair, and now overdone. And so the question is it normal to just back and fill? It is. There's not a lot to see here by my work.
Mm-hmm. A lot of people asking about software stocks, and if Amanda or Jacob or Cece can pull up a Salesforce CRM, and this is, for as many things as I get wrong, this is one that I think we've actually done a decent job with. Salesforce traded down to about 230-ish in the summer of 2024. Obviously had a huge run, then subsequently traded down to about 230 in April. Bit of a bounce. We traded back down to 230 middle of August or so. Now we're bouncing. And what I've tried to point out is we held support here. And, if you ever to see sort of a rotation out of semiconductors, you could potentially see a move into some of these software names. And again, I don't know if today is anything, the fact that we're above the 150-day moving average, but are you seeing anything in the software names? Obviously, I just pulled Salesforce out of the blue.
Yeah, it's a bifurcated group. You point to there are great strong ones, of course, and then there's the ones that have really lagged like this. Take, for instance, and we could pull up a chart of Adobe. I mean, Adobe has been like CRM, just something that cannot get a bid, catch a break when so many software stocks have been fantastic. And you're seeing a bit of strength in Adobe. You're seeing it today in CRM. To me, it's too little too late, so to speak. I don't think these are great catch-up trades. I think they're just having a little bit of life, but they are generally speaking lifeless.
Yeah, you know what? I don't disagree with that. If we put up that Adobe chart real quick and you can look at those lows, this looks a lot like the Salesforce chart. If you think about it, I mentioned those lows back in 2025, the April low. Obviously, we saw it in August. We saw it again a little bit in September, October. So you have all these series of bottoms, and now we've held theoretically and are bouncing. I guess the 150-day moving average theoretically is in play. Although, again, each time we bounce, we have made a series of lower highs. Now, we stopped making a series of lower lows, but we're still in the midst of a series of lower highs. So I guess for this to sort of take hold, you got to close above that 150-day moving average or somewhere along those lines.
Yeah, it's just too little for now. It can develop, but it's nascent, and I would say stand aside.
This is a good question, and I think I'm equipped to answer this, but they're not asking me; they're asking you. It's from Scott A, and I'm going to read. So I'm putting my eyes down. I apologize. Last time we were at this level in the SPY was October 8th. The RSI was overbought. Now what they're saying is we're at the same basically S&P level, but the RSI is about 60. So basically what they're saying, and I know you know this, is the last time we were here, we were in a completely overbought condition. We're at the same level now, but that overbought condition is not nearly as significant as it was, I don't know,
That's how
weeks or so ago. So, my instincts suggest, when you give the market a period of time to work things off, the market can go sideways for a period of time, work off the overbought condition, and then get back on the rails, as opposed to just cascading lower to work it off. And I think to a certain extent, that's probably what we're seeing. Am I accurate there?
Well, yeah, that's the nature of oscillators. Whether they're about 140 recognized price oscillators, if you can believe it. I mean, the ones that are trafficked in are Bollinger Band and MACD and RSI. And there's DeMark, but they're literally, you can Google this, about 140. So the question is, and each one has its formula and its math, but the issue with them, though, they're all too formulaic. If it were that easy, you could just plug in the software. Oh, RSI this, RSI that. But the nature of something that advances or declines in an unrelenting and persistent way that then backs and fills, the oscillator will give you a lower reading or higher reading, depending on overbought or oversold, even though the security itself is unchanged. So the S&P is exactly where it was 1 month ago, right? We've basically done nothing. And so this sideways action is generally, one can interpret it as one of two ways, essentially. It's stalling, it's churning, it's losing its momentum, and it's the precursor to a rollover. Or the bull says, no, it's just resting. That's what happens after you exert yourself. And so it's normal. And then after a proper rest, consolidation, it will resume its uptrend. It's right now in sort of the 50-50 category. We shall see.
There's from Gary Webb, who's here every day. Taiwan semi is sold off since earnings. CBW, to see the semis as being vulnerable. If not, what would you want to see to confirm the break in the uptrend? And, again, it's hard to say they're vulnerable here, but I understand the impetus of the question. I mean, they're showing some cracks, but, you look at the SMH or the SOX or whatever you want to look at, here we are in the SMH at 345. I think the all-time high was 350. So, it's hard to say you're seeing a rollover, but it's easy to say that you have been seeing what seems to be an uninterrupted parabolic move higher. So what are your thoughts on that?
Yeah, I mean, the nature of indices is you're so skewed by a handful of names. The important thing I would say is that if you look at AMD, for instance, it's very much intact, and others, MU, but the two big ones, Avago and NVIDIA, are churning and stalling. I would say it's not so much about whether the SOX has downside. Everything has downside, right? If you're going to either have a general market give back or something that's specific to the instrument in question, idiosyncratic. It's that to the SOX as an aggregate, does it have a lot of upside? As long as Avago and I guess they call it Broadcom, but as long as Broadcom and NVIDIA are sort of churning here, and we can look at both of those patterns, I would say the SOX or the SMH has little upside.
Question about Goldman Sachs, and this is from Steve Lee. Can you provide a technical update? Goldman has not seemingly participated with the broader market, and this is since Goldman reported earnings. What I can tell you from my history of watching these things, and Carter can obviously speak to this, Goldman is one of those companies that runs up into earnings and sells off in the aftermath of earnings, only then to get back on the horse within a few weeks after the fact. And I don't see anything here that changes my opinion of that. Maybe you do. Some thoughts on Goldman Sachs?
Well, if you think about what these in particular, right? They're the epicenter of all the things that are going on. They traffic in gold trading. They traffic in the underwriting of technology stocks that are booming or busting. And so it's just beta. Let's put it in this context. What did the market's peak to trough decline from the tariff February to the tariff low? Was 21%. Goldman dropped 34%. Okay, how about from the tariff low of April 7th to sort of present? The S&P's up 40, Goldman's up 88. And now, of course, Goldman's pulled back a bit. It's beta, right? These are highly sort of boom-bust businesses. Their brokerage firms have gone out of, I think, probably the most bankruptcies in the history of the United States, banks, right? Has to be. It's not autos or steel. They're always trains and planes and companies. Airlines are up there too, of course. But I mean, the point is that this normal pullback is, that's all I'd characterize as normal enough. I mean, I don't think it's particularly exciting as a buy here, but I don't think that one can interpret or read into the 3-4 week pullback as anything other than the stock went up 87% off its April low. It's entitled to pull back.
The final question is from G Swizz. He's here every day as well. Not the brightest bulb in the fixture, but I'll entertain his question. Carter, you've been spot on in terms of the move in yields. And his question to you is, are you starting to see the formation of a bearish to bullish reversal in the TLT, trading 92 today? Obviously, basically this is now since the fall of 2022, where we're starting to see some signs that this downtrend might be reversing.
Yeah, I mean, that's the nature. Rates are rolling and topping. The inverse, of course, is the underlying security itself. So I'm a buyer of Treasuries, 2-year, 10-year, and you can do that in the equity market through the TLT or the SHY, which gets you the short-term 2 and 3-year maturity. But yes, well-defined bottoming out action in TLT, and there's every indication that it's headed higher.
We have a couple questions about the autos. GM is having a move that we haven't seen in quite some time. I think it's up 15% today. This is General Motors, by the way, for full disclosure. I mean, we're up towards levels that we probably saw 4-ish or so years ago. Does this show signs of exhaustion? Typically trades about 8 million shares a day. I don't excuse me. I don't have it in front of me, but we're probably on pace to do 4 or 5 times normal volume.
Yeah, we're right back at a former high. I think that was in 2022, and it was in the mid to high 60s. And here we are back there again, which is an incredible thing. But do you, after a day like today, right now, what is it, 11:29? Do you buy new shares of GM for the first time after having gapped up like this, $9? I would say no. Do you short it right here with new money because it's gapped up that much? Not the best technique either. After a big one-day thing, you often get a follow-through day or 2 or 5. The question is, if one owns it already and it's just been paid today, do you sell some calls? Yeah. Or do you trim it 10%? Yeah. That kind of thing.
That is the bearded great Carter Braxton Worth. Let's throw the slide up because I get a kick out of the picture. I don't know when this picture was taken, but it's you in a youthful. Look at that. That's great hair.
But there it is.
It should say great hair. Nothing slick, just my hair. Carter, you're the man. Thanks for joining us. Dan's back tomorrow. Folks, thanks for being here. We'll talk to you later.